Welcome to this explainer. If you're looking for that classic portfolio protection of precious metals, but, don't exactly have the space for a heavily guarded vault in your basement, well, you are absolutely in the right place. Let's dive into the modern digital alternative. Seriously, why buy a vault when you can just buy a ticker? It's kind of fascinating to watch modern investors completely ditch the massive physical hassle of traditional bullion. You're essentially trading all that anxiety of hidden safes and expensive security for a simple, clean, digital ticker symbol right inside your brokerage account. By using exchange-traded funds, or ETFs, we get all the direct financial benefits of holding precious metals, but with absolutely zero heavy lifting. Here is our roadmap for today's explainer. We're covering the digital metal age, gold versus silver, the 4 ETF types, and finally, the top Indian market options. All right, Section 1, the digital metal age. Let's clearly define the assets we're talking about. Let's kick things off with the heavyweight. A gold ETF is basically a commodity-based mutual fund that primarily invests in actual, real-world gold bullion. And what's really brilliant here is how incredibly intuitive they've made it. Generally speaking, one digital unit equals exactly 1 gram. It's a direct digital slice of real bullion, which makes doing the math for your portfolio incredibly straightforward. Now, this right here is what builds real trust. You aren't just buying some flimsy paper promise. Each gold unit you buy actually represents 99.5% pure physical gold that is sitting securely in a vault somewhere. That strict, high-purity standard, that's exactly what ensures your digital asset reliably tracks the real-world value of premium bullion. Now, silver ETFs, they operate with a slightly different kind of structural flexibility, which is pretty interesting. By definition, a silver ETF requires at least 95% of its assets to be invested either in physical silver or in silver-related instruments like derivatives. So it gives the fund managers just a tiny bit more breathing room to maneuver while still keeping the asset's value heavily tethered to the metal itself. And to maintain absolute market trust, the physical silver backing these specific funds hits an incredible 99.9% purity standard. Honestly, it turns out that whether you're stacking digital gold or digital silver, the quality of the underlying asset you are holding is just exceptionally high.
Moving right along to Section 2, Gold versus Silver, the showdown.
Despite both being these highly sought-after shiny metals, they actually serve entirely different masters. Look at it this way. Gold is your slow and steady safe haven. It's the classic bunker where capital retreats when inflation spikes or when the broader markets start panicking. Silver, on the other hand, is a highly volatile industrial engine. Its price is aggressively driven by massive, continuous global demand for manufacturing things like solar panels and everyday electronics. When it comes down to your wallet, think of it like this. Gold definitely requires a higher cover charge to get in, but thanks to its historic demand, it's highly liquid and incredibly easy to trade in and out of. Silver, however, throws the doors wide open for smaller budgets to jump into commodity investing. It is a highly affordable entry point, even if it trades with just slightly lower liquidity compared to that massive global gold market. All right, into Section 3, the 4 ETF types and their market mechanics. Depending on your specific strategy, there are 4 distinct structures you can use. These escalate from simple, tangible vaults all the way up to highly complex engineered market instruments. Let's quickly break down how each one solves a very different kind of investor headache. The most straightforward option, hands down, is the physical ETF. This simply means a fund manager takes the cash you invest, goes out, buys actual metal bars, and locks them inside a highly secure, heavily insured vault on your behalf. So when you own a share of this, you own a direct claim on that physical metal sitting somewhere in the dark. On the flip side of that, we have synthetic ETFs, and these funds never actually touch the physical metal. No vaults, no bars, nothing. Instead, the fund relies completely on financial derivatives, like futures contracts and options, to digitally track the price movements. It's a hyper-efficient way to capture the price action without ever having to deal with the crazy logistics of shipping heavy metal around the world. Now for the highly aggressive trader, we step into the realm of inverse or leveraged ETFs. A leveraged ETF might actually aim to give you double or even triple the daily return of gold. An inverse ETF? That actually profits when the metal's price crashes. But a very serious warning here. These are sophisticated, high-risk tools that require active daily management. They are not for the faint of heart. Finally, we have the fund of funds, or FOF. This structure basically pools everyday money to buy an underlying ETF. The absolute biggest advantage here? you get to completely bypass the friction of needing a specialized DMAT brokerage account. It wraps your metals exposure neatly up into a traditional mutual fund structure that most regular investors are already super comfortable with. Which brings us to Section 4, Top Indian Market Options for Early 2026. Looking at massive assets under management and recent performance, three heavyweights really lead the gold charge. We've got Nippon Gold BeES standing out for its historic liquidity. Then there's HDFC, which is heavily favored right now for its highly competitive expense ratios. And of course, the SBI Gold ETF, which leverages the immense institutional trust of India's absolute largest public sector bank. Rounding out the top 5 for gold, we can group the remaining leaders by their specific strengths. ICICI Prudential really stands out for its pinpoint accuracy, minimizing tracking error to domestic prices, which keeps your investment tightly synced with the local reality. Meanwhile, Kotak dominates as a major player with absolutely massive institutional trading volumes across the exchanges. Now, shifting gears to the highly active silver market, Nippon India currently holds the AUM crown, controlling the largest share of assets. But ICICI Prudential is a fiercely competitive alternative, well known for its highly active management style. And Kotak? They are riding some incredibly strong performance momentum, carrying right over from 2025. Completing the silver landscape, HDFC provides a rock-solid, stable tracking option for domestic silver movements. On the other hand, the SBI Silver ETF uses its massive, sprawling ecosystem to give retail investors incredibly easy, broad access all across the country. As we wrap up this explainer, the most important takeaway isn't which metal is objectively better. It's really about understanding which specific asset profile perfectly matches your personal risk appetite and your own financial goals. Are you seeking the stoic, historically proven safe haven of gold to build a fortress against inflation? Or are you looking to capitalize on the active, highly volatile industrial engine of silver? The true beauty of the modern digital market is that you have the tools to choose either or, a perfect customized blend of both, without ever having to lift a single heavy metal bar. So, I'll leave you with this final thought. Looking at your own financial goals, how will you balance your digital vault? Will you anchor your portfolio with the reliable scarcity of digital gold, or will you ignite it with the hyperactive, accessible growth of silver?